Welcome back. As promised, let's get that conversation going with Varun Lohchab, head of institutional equities at HDFC Securities. Varun, great to have you on the show. As always, plenty to talk about because a lot has happened in this week itself in terms of regulatory moves. So let me start with the NBFC space, given the movement that we've seen, with respect to two specific entities that the RBI has undertaken. What is your stance? Do you think this remains restricted to just the entities in question, or could it cause a bit of a disenchantment from the NBFC space and become an excuse to start shifting positions elsewhere, maybe to banks?
So I think, clearly, if you see RBI's actions over last few months, even if you recall the way they were talking about, the sort of fast growth on the personal loan side, and they were not very comfortable. And these actions of late on some of the fintech companies and NBFCs clearly goes to show that regulator is kind of trying to be proactive and making sure that there are no bubbles getting created in any segments. So medium to long term, we believe that's a positive stance. And NBFCs, I think if businesses are run in a, in a proper way, and all the risk mitigants are there, then I don't think there is anything to worry, particularly on NBFCs. We have been favoring banks over NBFCs over last 12 to 18 months. While we had few select NBFCs as buy calls, but unless the business model is really differentiated or you are buying them for their niche expertise in a certain segment like a CV financier or somebody like a Bajaj Finance who have a great distribution mode, we believe there is limited case to buy a very broad-based sort of NBFC with no expertise or niche area. I think compared to those, banks are better placed. But if you find a right NBFC at a right price, then they could be looked at. I would not get overly worried. It's just that some of the NBFCs, the ones which we had liked, had run up a lot. So we had reduced our weight in NBFCs further, and we are actually overweight banks in that sense and underweight NBFC, and overall sort of neutral on lending financials.
Right. And since we are on the subject of broader markets, Varun, I had mentioned in one of your notes that you had released last month, you had mentioned that the mid-cap index, the small-cap index and the Nifty all appear to be overvalued. Since then, the market has gone from strength to strength. Do you still advise recommending taking money off the table at these levels? Do you not find valuations comfortable?
Yeah, so what we had done was we had analyzed, the past and looked at where, how big is the overvaluation and is it broad based? And clearly, as per our analysis, actually all three indices are were looking overvalued. But within that, obviously, small caps looked the most stretched, followed by mid caps and then the Nifty. Within that, again, there were only few sectors which were not looking too expensive. Like in case of Nifty, we called out banks and staples, which are relatively less expensive. Not to say that they are really cheap. And what we said was that almost 70% of all the index constituents across the three indices are looking overvalued compared to a 10-12 year history. And such sort of broad-based overvaluation has only happened thrice in the past 20 years, out of which only once, which was in 2000, when it happened in 2007, 2008, there was a sharp correction which corrected the overvaluation. But in the other two instances, we didn't see a very sharp fall. But at the same time, the returns uh, became fairly modest in the subsequent couple of years. So, I think it's difficult to see triggers for a very sharp fall as of now. But we believe the returns from here on in all the three indices would be fairly modest and muted over a couple of years, which is FY25 and 26. And what we have called out is therefore this broad-based easy returns which we got in last 12 months is probably over, and now the rally will keep getting more narrower, and it would be more bottom-up stock picking which would yield you returns rather than just buying any of the indices.
Okay, Varun, before we let you go, just caught this, this caught my eye. You, I think, have a negative view as a house on Tata Motors. Is that right? Just run us through the thought process here, because now the company is going to go through this big demerger. And what do you think will happen in terms of the valuation of the two businesses, JLR and PV on one hand and then CV on the other? How do you think this will play out?
See, I think demerger per se does not change the valuation picture for us, because we were anyway doing sum of parts for all the three businesses, which was India CV, PV, and JLR, and actually even EV side. So I don't think there is any under discovery, or sort of market was not paying up for any part of the business. And in fact, if you see, all the three parts have been doing reasonably well, and that's why our negative stance is more to do with the fact that now it's looking sort of fully valued, because JLR, the better profit margins are in the price and in the estimates. If you look at it, CV cycle is probably now turning for the worse after having done quite well over last couple of years. And PV story, I think, while that still has legs to go and Tata Motors is doing exceptionally well out there, it's again not as underappreciated as it was 1 or 2 years back. So in that context, we believe valuations are looking sort of full to us. On that valuation argument, we have a cautious stance on the stock.
Right. All right, Varun, we'll leave it at that. Thanks a lot for joining in and sharing your views on specific sectors and your view on Tata Motors as well. Time for a short break here on Trading Hour. Next up, we'll get chatting with Janmejay Sinha, the chairman, Asia Pacific at BCG, on the big RBI crackdown on lenders. Stay tuned. We'll be right back.